So that's pretty much covered the fundamental parts and the sentiment of the market, how you interpret sentiment to really gauge your trading pattern or on how to trade the market more to the news flow and more to the sentiment approach. Now, really entering the market on a daily basis, you tend to use technical as a way to navigate. So I'm doing this on a full-time basis. I believe technical strategy is a way for you to start off with to really find opportunity on whether it's on the daily basis, whether it's on an hourly basis. By looking at a chart, you can able to determine whether the market will continue to be bullish or bearish. So I break down to certain steps. I think there are 5 major important steps I need to take. The first thing is to identify the major trend. Now, a trend trader will always trade the trend. If the trend is telling you that overall trend on the market is going bullish or going up, you find opportunity to find a long position. You should avoid taking bearish or rather to short the market, especially when a trend is bullish. Never go against a trend, because if you're going against a trend, you can get caught very easily. Now, there's a lot of ways to identify the trend of the market. You can look at it visually. For example, if you just look at the prices, whether is it higher high or higher low. If it's higher high, higher low, that means the market is bullish. And if it's a lower high, lower low, that means the market generally is quite bearish. One way is visual. Another way is to plot the exponential moving average line. Normally the market use a 200 period EMA. I think that's fair enough, it's good enough. So if prices are trading below the 200 period EMA, that means the market is on a downtrend. And if the prices are trading above the 200 period EMA, that means the market is on an uptrend. If it's sideways, if it's just closing the line, it's a sideways market, there's no trend. So when there's no trend, you have to use a different strategy. So I like to use the 200 period EMA to determine the trend. Once that is identified, we can use ADX, which I'm going to share with you later on. And to enter into the particular buy and sell signal, we use candlesticks and we use moving average crossovers, because these two is quite sufficient for you to make buying and selling decision. Now, just to show an example, you just look at corn and soybean and you just plot a 200 period EMA. You notice that corn and soybean has actually turned downtrend early part of this month. Now, the key question is, although we see the rally back in both the markets, again, it has to retest the 200 period EMA line. If it does break above the 200 period EMA, that means there's potentially a trend in place. It could be a reversal trend. That means the market is from a bullish turning to from bearish turning to bullish, or the 200 period EMA could be a very strong resistance. So I think this was taken snapshot early part of this week. Things has changed. I think both these markets are retesting the 200 period EMA. So watch out. I think in the next couple of days whether can corn and soybean break the 200 period EMA. If it does, that means the market is actually is changing its trend from a downtrend to an uptrend. Now, wheat I think is above the 200 period EMA now. Again, it's by not much. So really, I think wheat is turning from a clear downtrend, to a possible uptrend. But again, I think wheat is affected by news flow coming from Russia. Just early part of this week, you saw that Russia actually strike an important port in Ukraine. I think that what causes the wheat to rally. So the key question is, can wheat continue to rally? If it doesn't, that means it will retest the 200 period EMA and it breaks below. Again, I think wheat is going to be on a downtrend basis. Now, once you identify the trend, it's important to understand how strong of the trend is. Normally, if a trend trader, you want to trade in a strong trend. You don't want to be trading a trend that is very weak. If you're trading a trend that's very weak, you tend to be, the market will tend to move sideways. So obviously, there's momentum in a trend. You should be trading with the momentum. So one way to identify strength in the trend is to look at what we call an indicator called ADX, average directional change. So really, if you just look at ADX itself, whenever ADX value goes above 20 and the trend is up, that tells you the strong uptrend, there's strength in the uptrend itself. So that's where you should take a position. But if the trend is going higher, but the ADX value is staying below 20 or at 20, then that tells you that the trend, there's no strength in it. So you have to be careful to use trend trading strategy, especially when the strength is not there. So if you just look at an example here, I think this is ADX value. Although it's trading above 20, it's showing you some strength, but you look at how the line has changed in the ADX value, it's actually crossed down. And in fact, you look at the candles itself, it's trading on a sideways market. So it tells you that actually generally the market is trading on a sideways pattern. Now, next, to identify buying and selling strategy, I always use Heiken Ashi. This is one part of Japanese candlesticks. The reason I use Heiken Ashi as compared to Japanese candlesticks is because Japanese candlesticks, you need to know all the different type of pattern. You need to know hanging man, there's 100 over patterns. It gets very tedious. Heiken Ashi, you don't have to worry about that. You just need to understand whether is it a green bar or a red bar. Green bar, that means the market is on an uptrend. Red bar, that tells you market is on a downtrend. If you see a series of red and green, that tells you the market is on a sideways market. It's as simple as that. So if you see green colored Heiken Ashi bars, generally the market trend is up. If you see red Heiken Ashi bars, generally the market trend is down. So that's how you use a trend trading strategy to use Heiken Ashi as a way to tell you whether the market is on an uptrend or a downtrend. Now, so Heiken Ashi dynamics, you can see, whenever you see a series of red colored Heiken Ashi bars, generally the market trend is down. Green colored Heiken Ashi bars, that generally tells you the market is up. If you see a series of red and green, that tells you generally the market is a sideways market. So when it's sideways market, if you're a trend trader, you need a different strategy. Now, besides Heiken Ashi, you can use Heiken Ashi together with moving average. And one of my moving average examples is to use exponential moving average type, comparing two different types. One is the 9 period and another one is 20 period. Why there must be two? Because you need one to be a shorter time frame. You need another one that's a bit longer. So the 9 period is actually the shorter one. The 20 period is a longer one. So whenever you see a crossover meaning if you see the shorter time frame crossing below the longer term, that tells you market is actually pointing you downwards. And if you see a red Heiken Ashi bar, that tells you there's the best time for you to short the market. So vice versa, if you see it moving upwards, crossing above, and you see green colored Heiken Ashi bars, that tells you the market is generally going to be higher. So if you just look at moving average crossovers, bullish crossovers are showing you by the shorter term crossing above the longer term. Bearish is the other way around, is where the shorter term crossing below the longer term. So again, I think these are all simple strategies that you can use by using moving average crossovers, the shorter term crossing the longer term. Now, to put everything into perspective, so one way is to look at the trend itself. And to look at that, you can always use the Heiken Ashi, and you have to mix that, or you couple that with moving average crossovers. So as long as you see green Heiken Ashi bars, and there's a crossover there's a bullish crossovers on your moving averages, that tells you the market may potentially go higher. Now, with every trading plan, it's important to have stop loss. Without a stop loss in place, you pretty much expose yourself too much of a risk. So every trading plan, every trade setup that you have, you must have a stop loss in place. So one of the key examples on putting a stop loss, key technical tool that you can use is to what we call ATR indicator, average true range. So average true range will tell you what is the high and the low for this particular period. So for example, if you just look at this time frame, the soybean market, the ATR value is about 3 cents. So that tells you that if I expect the market to go higher, I decided to take a long position here. I work a ratio, so I want my reward to be 2 to 1. So if I'm looking at ATR value of 3, that means my reward should be 6 and my stop loss should be 3 cents. So that's how I use ATR to determine my stop loss level and my taking profit or target profit level. So we always use ATR value for us to determine where is the stop loss point that is crucially whenever we enter. Now, obviously, when market become very volatile, your ATR value will increase. So eventually your stop loss level will be even bigger and wider. So that's important for us to take note. If you are using ATR value, you have to measure that the volatility of market will increase, your ATR value will also increase. So again, I think this is another example on soybean. So you look at it, there's a bearish crossover on your moving average, red Heiken Ashi. So there's a good position for you to take a short position, and the ATR value is about 9 cents. So if you want to take a reward to risk 2 times, that means you take 18 cents as your profit level with a 9 cents as your stop loss level. So that's how we use ATR to measure your risk. So again, take note, if the volatility of the market increase, your ATR value will also increase. So this is basically a contract specs for corn and also soybean. I believe Philip Futures will be kind enough to share with you what are the listed contracts that's available on CME, especially when it comes to grains market. I believe they can share with you in further detail. So I always get this question a lot from the audience: is that is there market, or is there liquidity, is there volume in the CME market? If you look at corn itself, on average daily basis, you're looking at about more than 100,000 contracts traded easily. So there's no issue of liquidity at all. In fact, the market is very liquid. You can even trade the market out to a year forward. So there's no concern of liquidity issue. Same goes for soybean. I think these two markets are very deep. So really, if you want to expose yourself in the grains market, I believe that CME Exchange is a very good platform for you to gain an exposure in the grains market. So a little bit of technical outlook. If you just look at the chart itself, again, the 200 period EMA line is going to be a strong resistance point for corn, which is about $6.50 to $7. If it does break that, I think the next level you're really going to look at is about $8 or $8 and above. So really, I think you have to watch out at those levels. If it does break that, I think corn is heading to a possible uptrend. When it comes to ADX value, I think the current downtrend still has some leg to go. You look at the value itself, is above 20. That means the strength in the downtrend is still there. Unless ADX value starts to point downwards, maybe the corn will probably head into a sideways market. Now, soybean is again very similar to a corn picture in terms of technicality. Again, I think the 200 period EMA is the major resistance point for soybean in the immediate term. So do watch out, pay attention to the 200 period EMA, because that's where it's going to be a possible resistance for the corn and soybean market.